Okay, so I guess we should have said a prayer before I started recording, because I still think it's weird to record a prayer, but yeah, they do it at conference all the time. So we're roughly on par with them, right? Anyway, so anybody willing to volunteer to offer a prayer? Becky will do it. She's not afraid.
I'll do it. I'm not afraid. Okay. Our dear Heavenly Father, thank you that we are able to gather this night and learn and be inspired from this class. And please bless that our minds will be opened and that the concepts will come easily to us. And please send out a prayer to those families in Texas at this time, that they will be comforted. And thank you for all the many blessings. In the name of thy Son, Jesus Christ. Amen.
Amen. Thank you very much. So I guess let me just start. I'm going to share a couple things with you. Like, let's just go over the concept of adjusting entries. So before I even share a screen with you, I think what gets lost a lot of times on adjusting entries is a recognition that they're financial adjustments being made by the accountant at the end of the month because of scenarios where either we received cash in advance and now or paid cash in advance, or we're going to receive cash or pay cash later. So adjusting entries will never have cash in them. And so that helps right there, just knowing if I'm thinking I'm going to put cash here, that's not right. Okay. And so there's 4 types of adjusting entries, and 2 of them are called deferrals or deferred entries, and 2 of them are called accruals. Okay. So let me bring up a little something on my screen here, and I'll share it with you. Maybe. There it is. In my office, I have like 2 big screens, and now I'm just on my laptop, and it's just not as awesome. We're spoiled. All right. So like I said, there's 2 types of adjusting entries for what we call deferrals, and 2 types for expenses. So the 2 deferrals are deferred expenses and deferred revenue. So deferring something just means putting it off, right, to the future. When we defer something, we're not going to. So when we say we're doing a deferred expense, what we're meaning is usually it means we're paying money at some point, and then in the future, we're going to recognize it as an expense. We're deferring the expense until a future period. Okay. So some of the most common deferred expenses are prepaid assets, which we learned about a little bit already, like prepaid rent or prepaid insurance. That's an asset that gets created because we pay for something in advance. So we pay for insurance coverage for the next year, or we pay for our rent for the next 6 months or something like that. So what happens is when we do that, if I pay for my insurance for the next 6 months, for the next year, I can't really claim it all as an expense right now, because I'm going to get the benefit of that for a whole year. So instead, what I'm going to do is create an asset, and the asset will be called prepaid rent or prepaid insurance, or whatever it is that I'm doing. So at the time when I initially started that, what I would do is I would debit the asset prepaid rent and credit the asset cash. I paid for it. So the adjusting entry comes in when I get to the end of the accounting period, and I have to recognize, oh, some of that prepaid rent actually got used up because I had the use of the building for the whole month, or however long it's been, or for 6 months or whatever. And so my adjusting entry then is to recognize the amount of that prepaid asset I used up and claim an expense for it. So for prepaid expenses, for defer, or sometimes we call them deferred expenses, my adjusting entry will always be a debit to an expense account and a credit to an asset account. So I'm showing that I have the expense, and then I'm reducing the amount of the asset because I've used some of it up. Again, this is prepaid insurance, prepaid rent, and things like supplies, right? If I buy a bunch of supplies, I don't want to call it all an expense right when I buy them. Instead, I'll claim them as an expense when I consume them or use them up. So I get to the end of the accounting period, I count up my supplies and say, oh, I've used $1,000 worth of supplies. I do an adjusting entry, a debit to supplies expense and a credit to the supplies asset. So that's the first type of adjusting entry, prepaid or deferred expenses. So here's an example. So here's how you'll see them a lot of times in the homework or on exams. So we paid $2,400 to cover insurance for 24 months. And we paid that $2,400 back in January. So they tell you this, and what's confusing about it is you think, oh, I have to enter the journal entry for paying $2,400 for insurance. And what they're telling you is, let's see, so on this one, on December 1st, they would debit prepaid insurance. And then the adjusting entry is to figure out how much insurance we used in prepaid insurance we used up during the month. So if it tells us it was $2,400 to cover 24 months worth, we would take 2,400 divided by 24 and say, okay, that's $100 a month is what our insurance costs us. So our adjusting entry at the end of the month on 12/31 is going to recognize that we used up $100 worth of prepaid insurance and claim it as an insurance expense. We debit the expense, credit the asset, prepaid insurance. So that is a deferred expense. It means the cash was paid in advance and we've deferred the expense until we actually incur the expense or use up use up that asset. And what will happen, if you think about it, is every month we'll do an adjusting entry where we debit insurance expense, $100, and we credit prepaid insurance, $100. And at the end of 24 months, we'll have fully used up that prepaid insurance. And rather than claiming a one-time expense of $2,400, we'll claim a $100 expense every month. And that makes our books more accurate because we're actually getting $100 worth of benefit from that prepaid insurance every month, rather than trying to take it all at once. This is especially important with really big assets because you buy a building or something and you can't just say, oh, I have a $300,000 expense. I'm going to use this building for 30 years, but I claim $300,000 in expense today and then nothing for the next 30 years. So similarly, okay, so so there's what the adjusting entry would look like, the debit to the insurance expense and the credit to the prepaid insurance. Supplies is another example. A lot of times, this is how they'll present this one. They'll tell you that you have $9,720 in supplies at the beginning of December, and at the end of December, you do a physical count of 8,670. Because if you think about it with supplies, you're not usually keeping track like each time you use a Post-it note of how much it cost or something like that. Instead, what you're doing is you're using them during the month, and then at the end of the month, you count them up and say, oh, well, now I have $8,670 worth of supplies. So we take the amount we had minus the amount that we have at the end of the month tells us how much we used during the month. So then we'll debit the supplies expense and credit supplies. And that's our adjusting entry to show how much supplies we've used and to take the expense for it. That's, again, what's confusing about these types of problems is most of the time they'll present it like this, but sometimes they'll say something like, oh, the account revealed that they used $1,050 worth of supplies during the month. And then you think you're supposed to subtract, but in that case, it tells you how much you used. So that's the amount. So that can be confusing. You have to read it very carefully because really what we're getting at with these deferred expenses is how much of that asset did I use up during the month? That will be the amount of my expense as well. Maybe I have too many slides here. All right. So depreciation on assets is another form of deferred expense. Okay. So when I buy a building, what I'm doing is when I buy the building, I will show the asset building going up, and I'll reduce the cash by the amount I paid for it. And then I'm going to use up the building over its useful life. Use up's probably not the best word from an accounting standpoint. Instead, what we really should be saying is we're going to allocate the expense or cost of the building over its useful life. Because a lot of times we get to the end of the useful life and the building still can be used, right? So we're not really using it up. What we're doing is saying I'm allocating the cost of that building over its life. But with depreciation, we do it a little bit different because we want to leave the asset always at its cost, and then we'll track any depreciation on a special type of account called accumulated depreciation. And accumulated depreciation is special because accumulated depreciation accounts are always linked to a specific asset account, and they show the amount of depreciation expense we've taken accumulated over time. Okay, accumulated depreciation is actually called, if you care, it's called a contra asset account. And by contra, we mean its normal balance is a credit rather than a debit like most asset accounts are. Contra accounts are also always linked to a specific asset account. So to figure out depreciation, we'll take the asset's cost minus its salvage value. That's the amount we think we could either sell it for or get out of it at its end of its useful life, and then divide it by its useful life. Now, this is tricky because if we're finding the useful life, if we want to find depreciation for a year, then we would divide it by its useful life in years. But if we're trying to find its useful life in months, then we would divide it by its useful life in months. So if it was an asset that we thought would have a useful life of 5 years, if we want to find a year's worth of depreciation, we would divide it by 5. But if we wanted to find a month's worth of depreciation, we would divide it by 60 because there's 60 months in 5 years. And that can be a little bit confusing. It's kind of like making sure you're working in the right units, years or months. All right, so here's our example. We purchased equipment for $26,000. It has an estimated useful life of 5 years, and it's expected to be worth about $8,000 at the end of 5 years. They purchased the equipment on December 1st. But now on December 31st, we've got to recognize the amount of depreciation expense we've incurred this month. So that's 1 month's worth, right? I have to sort of identify how much I'm trying to find here, 1 month's. So to figure it out, I'll take the original cost minus the salvage value, and that gives me the net cost. Sometimes instead of net cost, they'll call it the depreciable cost or something like that. You'll see that term. And then I take that 18,000 and divide it by 60 months, or the number of months in 5 years, and realize that that's going to be $300. So in real life, what's nice about this is once you've calculated your depreciation, then at the end of each financial period, when you do your adjusting entry, it's super easy because it's already been calculated. You just go back. I seriously just scroll up to like last month's entries and go, oh yeah, it was that much. And actually with QuickBooks, you can just say, copy this entry, right? And it'll redo the new one and you put the new date on it. But that's how you calculate it. So the journal entry then will be a debit to depreciation expense and a credit to accumulated depreciation. So the same pattern for all deferred expense entries is a debit to the expense and a credit to the asset. Just that with depreciable assets like this, instead of crediting the asset directly, we credit its accumulated depreciation account. So that's what it would look like: debit to depreciation expense, credit to accumulated depreciation. So those are our deferred expenses. Okay. Again, those come about because we've paid money in the past, and now in the present, we're having to recognize the expense for that money we paid in the past, whether it be prepaid insurance, prepaid rent, supplies, or depreciating assets. It's all the same in essence, which is a debit to the expense, credit to the asset. They're showing us what it would look like on the balance sheet. You'll see that it says equipment less the accumulated depreciation, and then it tells you that. Or sometimes you'll also just see it listed as equipment net, which means equipment less the accumulated depreciation. All right, so now deferred revenues. So deferred revenues mean that we received money in the past, and now we've earned some of it in the present and have to do an adjusting entry to show how much of that revenue we've earned. Okay, So with these situations, we have a client who pays us a 60-day fee in advance. And so whenever that happens, when someone pays you in advance, you do this entry where you show your cash going up and your unearned revenue account, which is actually a liability, even though it has revenue in the name, but that means money you've received that you have to pay back or do the work for. So then we're going to recognize on 12/31, we need to do an adjusting entry. So if this started on 12/27, and now we're doing the adjusting entry at the end of the month, you'll notice adjusting entries are always done at the end of a period, usually a month, okay? Then we have to figure out, well, how many days worth of that did we earn? So 12/27 to 12/31 is 5 days. So we would just take, they show it as 5 over 60 times 3,000, which they're saying 5 days, we've earned 5 days out of the 60 days. My brain, that wouldn't work. It's the same thing, but for my brain to take the 3,000 and divide it by 60 would tell me how much 1 day's worth of revenue is, and then multiply that by 5, which again is the exact same thing, but sometimes I have to talk my brain into it from that direction. So we figure out, okay, as of 12/31, we've earned $250 revenue. So our journal entry, that's just showing what the initial, when we receive the money in advance, would look like. Okay, the cash and the unearned revenue. And then our adjusting entry is going to be a debit to the unearned revenue account. So we're reducing that liability, and a credit to the revenue account because we've now earned it. So these deferred revenue accounts always look the same, which is a debit to the liability, usually unearned revenue or something like that, and a credit to the revenue account. Because what we're doing is reducing the amount we owe and showing how much we've earned during this period. Now, during the next month, they're going to earn, during January, right? They'll earn a whole month's worth. So that'll be a larger adjustment at the end of January.
Wait, I'm sorry, can you go back to that last one?
Sure.
How come it's showing for the balance sheet 2,750 and then for the income statement 6,050? Like, wouldn't you?
Because they
Like,
had
if
some
you do
other
one to
revenues.
one, you do it the same to the other?
Yeah, but it's a little confusing here because we don't know the other previous transactions, but they already had a balance in their revenue account from other revenue they'd earned during December.
Oh,
But the adjustment is just the amount that they earned. So this would be probably the revenue they earned just by doing jobs throughout the month. And then at the end of the month, this would be the adjustment for the amount that they had been paid for in advance. Does that help?
it does, yeah.
Okay. So the adjusting entry, again, always a debit to the unearned revenue. Remember, that's a liability account, and a credit to the revenue account. All right. So that's really it. That's the only example for deferred revenues, because that's all there is. And some businesses do a lot of deferred revenues and some hardly do any. So I own a storage business. We do tons of that, where people say, hey, can we just pay you for a year's worth? Instead of paying you 50 a month, can I just pay you $600? So we can't record that all as revenue. We have to record it as unearned revenue, and then each month show that we've earned some of it. All right. So now we're into the accruals. So there's accrued expenses and accrued revenues. Okay. So what's different about the accrued ones is here we haven't been paid any cash in advance. Instead, we're going to be, or we haven't paid any cash in advance like we did with the deferrals. Here we are going to be paying cash in the future. And so a lot of expenses, the most common one would be like our salaries and wages. Okay, those accrue, meaning they just sort of add up over time. And so usually we don't even worry about entering our salary and wage expense until we pay our employees, and then we enter it into the system. We debit wage expense and credit cash, wrote the paycheck. But unless we do our paydays exactly on the 15th and the 30th or 31st, then we're going to hit some point where we get to the end of the month and we owe our employees money for what they've worked, but we're not actually going to pay them until the next payday. So at the end of the month, we've got to recognize that expense for the salaries and wages we've incurred during the month, even though they won't be paid until the next payday. In other words, it's and like our utilities are kind of like that too. We've really incurred them, even if we don't pay them till next month, we've incurred them during this month. And so accrued expenses are expenses that we are recognizing now, but we're not going to pay it for until later. Okay. So here's an example. They pay their employees $70 per day or $350 for a 5-day work week. 12/31 is a Wednesday. So 3 days of salaries are owed at the year end, right? Monday, Tuesday, and Wednesday. People have worked for that, but won't be paid until Friday. So what we have to do is do an adjusting entry to recognize we have that expense, or else our income statement won't be right if we don't have all the expenses on there. Okay. So we take $70 a day times 3 days and do $210. And then we do an adjusting entry. We debit salaries expense and we credit salaries payable. And so remember that these always look the same. It's a debit to an expense and a credit to some payable, something we're going to pay in the future. And again, like before, apparently they had already incurred $1,400 in salary expense before this happened. Now with the adjustment, the new balance at the end of the month will be $1,610. Just to show you what it will look like when we get to our next payday, then we're going to actually pay our employees. So what we'll have to do is get rid of that salaries payable that we'd entered on December 31st. So we'll debit salaries payable. Plus, we'll debit salaries expense for any amount incurred during the new month, January, and then we'll credit cash. So again, this only occurs when our pay period falls over the end of a financial accounting period, where we have to recognize the expenses at the end of that accounting period. And then when we get to the next payday, we're going to get rid of the payable by debiting it and then pay them any money that they've earned during this new month. And then finally, an accrued revenue. So an accrued revenue is where we've earned money this month, but we're not going to get paid for it till the future. And so again, we have to recognize that we've earned that revenue during this period. So let's see. So our example is our customer agrees to pay us $2,700 on 1/10 of next year. Let's see. Oh no, on 12/12. Let's see. On 12/12, the customer agreed to pay $2,700 on 1/10 of next year for future services over the next 30 days. So by 12/31, we've earned 20 days worth of that money. Okay, so we're doing the work for them, but they're going to pay us upon completion of our work. So what we have to do is take 2,700 and divide that by 30 to get the daily amount, and then multiply that by 20 days. And so at the end of the year, we'll say, hey, we've earned $1,800 this year, right? And we're going to earn the remaining 900 in the next year. So for these, what we're doing is recognizing revenue we've earned, even though we haven't been paid for it yet. So the entry will look like this, where we debit accounts receivable, money owed to us, and we credit the revenue account to show that we've earned that money. So again, we'd add to the revenue we already had. This allows our revenue to be accurate at the end of the month, right? If you think about all these adjusting entries, their main purpose is to allow our revenues and expenses to be accurate at the end of the accounting period so that we can make our financial statements. So our income statement will be correct. And they also allow our balance sheet items to be correct, right? Because we now have this accounts receivable on there for money that's owed to us. And this sounds small, but if you're someone like Walmart or Apple and your accounts receivable could total $1 billion or something like that, then your investors would want to know, right? If you actually had $1 billion in additional assets there that weren't showing. So this is why they have, we have to do these adjusting entries at the end of each month. In the future, when we actually receive the money, we'll show that our cash went up by $2,700. Our accounts receivable went down by $1,800 because it's no longer owed to us, it's being paid, plus the revenue we earned during January, so the 10 days worth there. So that would be the future event where we actually get paid. Okay, so that covers adjusting entries. There's really only 4 kinds, right? And they're broken into 2 categories, deferrals and accruals. And we have deferred expenses and deferred revenues, and accrued expenses and accrued revenues. The hardest thing about these is usually having to read them so carefully to figure out, are they giving me the number I'm supposed to use, or I'm supposed to calculate the number I'm supposed to use for the amount of the adjustment? That's the part that always gets me confused anyway.
For the consulting revenue on this
Uh-huh.
one, I thought revenue goes up by a credit.
Right.
So don't you want it to go down because you already recognized the revenue in the last one?
Well, so we recognized 1,800 of the revenue in the last one. So now we're just getting rid of the account receivable that went along with that. But then we're recognizing the amount of revenue that we earned during January. So it's going up there. So previously, when we did the adjusting entry, we recognized 1,800 of revenue and created a receivable, meaning money was owed to us.
Mhm.
Here we're getting rid of the receivable, showing now that it was paid, and recognizing the additional $900 we earned from January 1st to January 10th. And that shows we got the full 2,700.
Oh, so the consulting, that's why I was confused, because the last one we had a consulting revenue
Of
and this was
1,800.
additional.
Right. So we earned a total of 2,700 in cash, but we earned 1,800 of it in December and 900 of it in January. So we had to do the adjusting entry at the end of December to show that 1,800 earned in December, which created a receivable. In other words, money we'd earned but hadn't yet been paid. And now, as we get the full cash payment, we're going to show we have been paid for this 1,800 by getting rid of the account receivable. Plus, we got paid 900 for the work we did during this time period, January. Does that help?
Oh. Okay, so they paid 27,000. Some of it was to pay off that accounts receivable that they owed us, and some of it was an additional paying for what we have already. Okay,
What we've done now in this month. Yeah.
got it.
Yeah.
And this is
And-
only for like the end of December, even if like we're counting January stuff?
Well, no, this is the entry. So this is the entry at the end, just January 10th, when we actually get paid the money.
Oh, okay,
So
okay.
up here, we have the adjusting entry where we recognize, oh, we've earned 1,800 in revenue, but we haven't been
Mhm.
paid for it yet.
Okay.
And then on January 10th, when we get paid for it, we're recognizing, okay, we got paid 2,700. 1,800 was for that amount that we earned in December that we didn't get paid for then. And 900 is for the amount that we earned in January.
Do you have to specify where that accounts receivable came from?
So yes. So like what we in real life, we keep track of accounts receivable by customer, right? So we know how much each customer owes us. It's all part of the same account, accounts receivable, but what they call it a subsidiary ledger, which means accounts receivable is broken down into all of these customer accounts. But for our purposes here, we're just trying to learn about the larger sort of overall flow of where money goes from and to. And again, QuickBooks helps you do that, right? And other, not just QuickBooks, but all accounting softwares, where usually you just go in there and create an invoice for the customer, and that automatically generates an account receivable. And then when the customer pays it, you enter the payment, and it does this journal entry for you. but we need to understand the journal entries, because when there's an error or something, you kind of have to go back through them and figure out where it went wrong. So even though computers do a lot of this work for us, we still have to understand the underlying process that they use.
So in concept, in theory, it's kind of like when, like I work in do for a chiropractor. So I'm doing billing and payments and people and all that. So sometimes we collect money in advance because they're like, can you just charge my card? I don't want to deal with this every month. And then sometimes we're waiting for insurance. So they're taking it and they, okay, now they owe this. So then they're going to come back and make a giant payment, basically wipe out accounts receivable.
Right.
Get it flush.
Yep. And there's another layer for medical practitioners, because they're going to have accounts receivable, but usually they'll have some sort of a expected insurance payment. So now you're trying to keep track of accounts receivable that the customer is responsible for and accounts receivable that the customer's insurance is responsible for. And if the insurance doesn't pay, then the customer's ultimately, yeah. So there's another layer of keeping track of that. So yeah. Okay. So let's take a look you could ask other questions too, but I was going to kind of get to the financial statement analysis problem. So let me stop sharing my screen for a minute until I get to that problem. Oh, it says I cannot minimize this when I'm in a meeting. Okay. Thanks, Zoom. Let's see.
I have to tell you, Zoom did me a dirty yesterday.
Yeah, that's what you were saying. I think you know what I think? I remember someone emailing me saying that the way they set it up, that it works with Canvas now, and you can get to your stuff through My Media. But by the time I saw your email, I saw you'd already posted your video. So I was like, okay.
I had to download a totally different thing, but I've been using Zoom for so many years, and I'm like, where's my recording? And I kept giving it a new place to put it, and it wouldn't.
Right.
It wouldn't save it anywhere. It was crazy.
My understanding is that the recordings now go to your My Media in Canvas.
I didn't even know we had a My Media in Canvas.
Exactly. Me neither. It's like you guys made this huge change without telling anybody. Like, that's cool.
I'll have to look for that. Thanks for telling me. I'll look for My Media.
Right. Well, I didn't email you back because I went in and saw you'd posted it. So I was like, oh, she must have figured it out. Like, I think I just put, glad you figured it out.
Oh, I ended up downloading like a screencasting or something just because it was 2 a.m. for me. And I was like, I have to be up at 5 for work and I'm dying here. I've got to get something up. And I kept like recording it over and over, and my voice was going out and I couldn't think straight anymore. And I was like, I don't even know if this is right anymore. So I ended up just getting it out there.
All right, let's see. So here.
I think the hardest thing with this lesson is honestly, like, we learned everything, but then like for these 4 things, it's like, it seems like it's somewhat backwards. It's like now you have to do the opposite in order to subtract it out. But then it's like, what 2 accounts are you working with now?
Right. And I will say, like, it's important that like the last chapter and this chapter are really foundation pieces. Like, it's important you get comfortable with them because they never go away. Like, even in accounting 2 or managerial accounting, there's still adjusting entries will still be there, and as well as just being comfortable with journals. All right, so here we are on. So Becky, are there specific parts of this, or you're just going like, I don't know what I'm supposed to do here?
I wish that I could say I could. It's just like when I go into that appendix A, I'm like, I'm lost. There's pages, and I'm like, is it this? I feel like there's 2 spots that I know. I mean, I know what the formula is. I'm trying to find the net income, and I'm like, is it this one or this? I don't know.
When you go to it, do Control F, and it will search the entire document, and then type in like net income, and then you can see all of the spots where it does net income.
I found it like net income in 2 different spots with 2 different amounts. So I'm like, okay, I know there's.
So here I am looking at Apple. I don't know, it's probably pretty small for you guys. It's not big on my screen, but so there we are on the balance sheet. So I'll
Now what
scroll
you're
down
saying, Becky, I found the
Net income is right there.
right here. So
That's
here,
one of the spots I found it. Okay, so
and then
that's the
here
net
it
income
is,
that I should be.
and it's the same numbers.
Yeah, it was on a different page. It was a different amount. So, okay. And then, so, okay, that's net income. Then so sales. How do I,
Down.
So let me, what was your question?
how do I find the net sales now? Because now that we've got that,
It's
that's
not gonna do net sales, it's just, yeah.
This
right
one
there, net
actually will
sales.
give you net sales right here on the income statement.
statement of operations.
Oh, it's hiding.
I couldn't find it before.
So yeah, I will say, so part of what's hard about this is they are like synonymous terms, right? Like income statement is sometimes called a profit and loss, sometimes called a consolidated statement of operations. And they're maybe not exactly the same, but think about what this has: sales, cost of sales, operating expenses. It's an income statement, right? It has everything that we would normally call. So there it is right there. So like for that, we would just take the net income. And let's see. Sorry, my
I didn't realize.
my Zoom
that
control bars.
consolidated Operations the same as income statement. I
I
keep looking for the exact words and then not realizing that it's not.
Yeah, and I know that's confusing. So like, we would just take, the formula
yeah.
and divide it out. And then sometimes the other thing that people like an easy mistake people make is they'll divide that and it'll get like 0.224 or whatever. And so they'll put 0.224 in here, but it's asking, because it has the percent, is that gets people too all the time. So I'll just throw that out there. If it wants the answer in percentage, then you have to sort of multiply your answer by 100, right?
Okay, thank you. That I just couldn't find it. So.
Okay, that answered your question.
Yeah, because I have the formula. That part didn't seem very hard the formula is easy. I just couldn't find
The numbers to plug it in.
yeah.
Okay.
Yeah, it's the numbers to plug it in.
Okay. And then what was the other one, Jessica, you wanted us to look at?
Mine was 3 and 6 and stuff, but I wanted to like go through the problems and everything, just because like this whole process is confusing. Sure.
Okay. So I'm gonna go to... That's sad. That's really sad.
That is quite a story.
Be okay.
I wish
Yeah.
my kids were still the age that you could just snuggle them and love them and the problems all go away.
I know,
Last night,
for
my
real.
daughter got in a car wreck and totaled my car. And it's not just hug and love and it's okay, it'll go away. And now I'm like dealing with the insurance mess.
Well, the hard
Yep.
thing is he's mad at his dad for something he can't do, but it's not my place. So he's
Pit mom gets dad.
no,
All right.
I'm his aunt.
That's not
Oh.
funny.
Yeah, my
Not funny. Sorry, I won't laugh.
Jessica, which ones did you say? I'm sorry.
I needed help on 3 and 6.
All right, let's take a look. Yeah, we were in church the other day, and like, and someone's kid was crying behind us, and I said to my wife, I don't miss that, because we were talking about how we missed just the bustle of kids in the house, and then after a minute, I was like, but I kind of do though, like even that. So anyway, all right. So here we have
I guess that's
adjusting
why we get to become grandparents.
it is
All the
true.
little things that we missed, we get it again
Yep. But then
eventually.
you can get rid of them. Like say, okay, because like after 3 days with them, I'm exhausted. So
Exactly.
anyway, all right. So let's take a look. So this is kind of exactly what we just went over, but examples of it. So this is a good opportunity to look at it. So I had to so I could see my screen, I had to minimize you guys. I'm not minimizing you as people, just as Zoom. But that means I won't see you if you raise your hand. You'll have to speak up if you have a question. So the first one is depreciation. So again, the question is always like, are they giving me the data I need to calculate this, or are they just giving me the number to use? So on A, depreciation on the company's equipment for the year is computed to be 13,000. So here they're telling us the amount of depreciation. So all we have to do then is create the entry. So we know that deferred expenses are always adjusted using a debit to the expense account and a credit to the accumulated depreciation or asset account. So here we're just going to do debit depreciation expense, credit accumulated depreciation for the whole amount it gives us, 13,000. For B, it says the prepaid insurance account had a $9,000 debit balance at December 31st before adjusting for the cost of any expired coverage. An analysis of the company's insurance policies showed that 1,680 of unexpired coverage remains. So again, remember that the key question is, well, how much did I use up? So I would take 9,000, what the balance was before, subtract 1,680, which is what the balance is now, and that would show that I used up $7,320 worth. So again, this is a deferred expense scenario. So I'm going to debit my expense, insurance expense, and credit my asset, prepaid insurance, by that amount, the amount we used up, or $7,320. C, the supplies account has a $360 debit balance at the beginning of the year. So this one, they're adding another layer for us. And we purchased $2,680 worth of supply during the year. On December 31st, a physical count showed that there's $425 of supplies payable. So in essence, what I would have to do here is figure out that I had 360 to begin with, that I purchased 2,680. So I had $3,040 worth of supplies available during the year. And then I would subtract out the amount that are still there at the end of the year. And that would tell me how much I used, or $2,615 worth of supplies. So then I would debit supplies expense and credit the asset account supplies to show the asset going down and the expense account going up. Any questions about those three? Because those are all three deferred expenses. Okay.
It's really just reading and figuring out the accounts and then what's doing what.
Yeah, well, and really asking yourself, how much of this asset did I use up? Because that's going to be the amount of my expense. And that's, and like I said, what's confusing is sometimes they'll just tell you, oh, you used $2,615 worth of supplies. And you're like, oh, that's easy. But other times it'll be like this, where they give you all this info and you have to calculate how much you used up. So that's what's tricky about these. So D, 1/3 of work related to $15,000 of cash received in advance was performed during this period. So again, we're not worried about that initial entry of receiving the cash. That's what it seems like. What we're saying is we've earned 1/3 of it. So we've earned $5,000, 1/3 of 15,000. So we're going to debit our unearned revenue account. Remember, that's a liability, and because we don't owe it anymore because we've now done the work. And then we're going to credit service revenue to show that we've earned that money. E, the prepaid rent account had a $5,800 debit balance at December 31st before adjusting for costs of expired prepaid rent. An analysis of the rental agreement showed that $4,120 of prepaid rent had expired. So again, the question is, how much did I use up of this asset? And in this case, it tells me $4,120 had expired, is another word for been used, okay? And so I'm just going to debit rent expense, $4,120, credit the asset prepaid rent, $4,120. Finally, F, wage expense of $2,000 has been incurred, but are not paid as of December 31st. So here, they're not telling us, they're not giving us any math to calculate. They're just telling us we've incurred this expense during the month. So we're going to take that amount. We'll debit wages expense, credit wages payable for the full 2,000. Okay, was that helpful to go through them that way, or does it create more questions?
It's helpful. It's just remembering everything. It's just gonna take time.
It's like it's helpful and it creates more questions, right? Like that. Sometimes we like to present things in false dichotomy, like either or, but really it's both. And then what was the other one?
6.
Jessica?
It's literally the exact same thing. It's just
Literally,
yeah,
or
pretty much.
or literally,
I
Chris
did
Traeger.
A on both of them, and then B, it's the insurance one that I got stuck in, where it's just like there's so much information in it, and I don't know how to break it down. It's just the process.
Okay, would it be valuable to just talk through these as well? I mean,
It has been valuable, yes.
okay, so let's just go through these real quick, and then I gotta go because my wife and I have to go. We had a friend who they're doing a dinner for tonight, so that I forgot about, like a bad husband, but now I remember. All right, so depreciation.
So
on the
you're a
co-
good husband because you remember. So that's good.
Sure. Depreciation on the company's wind turbine equipment for the year is 5,700. So that's telling us the amount of depreciation. So that entry is going to be a debit to depreciation expense and a credit to accumulated depreciation on the equipment and the full 5,700. Other times they might tell us how much we paid for it and what the residual value is and what the useful life is, and we'd have to calculate the amount of that expense. But here they just tell us this is what the depreciation is. For B, the prepaid insurance account for the solar panels had a $2,700 debit balance at December 31st before adjusting costs for any expired coverage. Analysis of the prepaid insurance shows that 9,500 of unexpired coverage remains at the end of the year. So that one, they're telling us we had 2,700 was the balance. Now the balance is 950. So again, I'm figuring out how much I used up. So I used up $1,750 worth. So I would debit the insurance expense and credit the prepaid insurance $1,750. On C, the company receives $5,100 in cash in advance for sustainability consulting work. And as of December 31st, 1/3 of that has been performed. So again, they're not asking us to do the initial payment entry. They're asking us to do the adjustment, 5,100. Since we've earned 1/3 of it, I'm just going to divide that by 3. Say, okay, during this month, we earned $1,700. So my adjusting entry then will be to debit unearned revenue. Remember, that's a liability. We're saying we no longer owe that money because we've now earned it, and then credit the service revenue account to record that we actually earned that money. Again, see, there's no cash in any of these adjusting entries. Why? Because the cash either happens before in the case of the deferrals or later in the case of the accruals. And so the adjusting entries will never have cash in them. D, as of December 31st, $1,900 in wages expense for the organic produce workers has been incurred, but not yet paid. So here they're giving us the amount of the expense incurred. So we're just going to debit wage expense, $1,900, and credit wages payable, $1,900. And finally on E, as of December 31st, the company has earned, but not yet recorded, $470 of interest revenue from investments in socially responsible bonds. The interest revenue is expected to be received by January 12th. So again, just telling us the amount. And so I'm just going to say interest receivable to be received in the future, 470, and then we'll credit interest revenue to show that was money we earned during this financial period. Okay. So that was a pretty quick run through. And we're about out of time. Any final questions or concerns? Okay, good. Well, I hope it was a fruitful hour or 55 minutes or so. And I appreciate it. And for those of you who came on Tuesday, let me just beg abject abjectly and try to be humble and say, I'm sorry, I totally just screwed that up, because in my last semester, I always did those meetings on Tuesdays and I put Tuesday in there. So sorry.
Forgiven.
Not confusing for a little while. It was okay.
Yeah, I'm sorry. Maybe there's this theory that if you screw up every once in a while, then the students see you as a real person instead of just a computer. And no, I really didn't mean to do that to you. All right, well, who could give us a closing prayer? But not Becky, because it's weird to say the opening prayer and the closing prayer. I mean, you could do it, but it's weird.
I can do it.
Terrific, thank you.
Thank you so much for the opportunity that we had to be able to come together as a class today, to be able to go over the material for this week. And please bless that we will be able to grasp this understanding, and that we'll be able to know how to do the problems and understand the material. And we thank you so much for all that has done for us. And we say these things in the name of Christ. Amen.
Amen. All right, thanks everybody. Have a great night. Good job, Aunt Jessica, taking care of that guy.
Thank you.
See you later.
Thank you.
Thanks.